5 rules that Warren Buffett learned from the intelligent investor. Rule number 1, understand Mr. Market and use his emotions wisely. Imagine you co-own a small car rental business that's doing well. You've built loyal customers, predictable cash flow, and healthy profits. Every morning, your partner, Mr. Market, shows up at your office with a new offer to buy or sell his share. One day, he bursts in saying, "Travel is exploding. I'll sell you my half for $1 million. The next morning, he's pale and gloomy, convinced the business is doomed because people aren't traveling anymore, offering to sell for just $40,000. His price changes every day, not because the company changed, but because he did. If this were real life, you'd ignore his wild mood swings and focus on your company's fundamentals, your bookings, your costs, and your long-term demand. But that's exactly what most investors fail to do with the stock market. They let Mr. Market's emotions dictate their decisions. Benjamin Graham, Warren Buffett's mentor, taught that the market exists to serve you, not guide you. Stock prices constantly swing based on fear, greed, or short-term headlines. They almost never reflect true value in the moment. Your advantage is recognizing this. When panic sets in, good companies often trade far below their intrinsic worth. When optimism takes over, the same companies can become wildly overpriced. Look at March 2020. As lockdowns hit, Mr. Market panicked. Stocks like Apple, Microsoft, and Visa fell sharply. Not because their businesses collapsed, but because investors were terrified. Those who understood Graham's idea saw opportunity, not danger. Buffett didn't panic sell. He waited, analyzed, and quietly bought quality businesses while others were frozen by fear. The lesson: stop trying to predict or react to the market's moods. Be the rational business owner in a world full of emotional partners. Mr. Market is there to offer you opportunities, not orders. Rule number 2, never confuse investing with speculating. Benjamin Graham's second rule is one of the most misunderstood concepts in finance. He drew a clear line between two activities: investing and speculating. Investing means putting your money into something you understand, a business with measurable value, proven earnings, and long-term potential. Speculating means betting on short-term price moves, trends, or hype, hoping to sell to someone else for more, regardless of what the company is actually worth. Think of it like real estate. An investor buys an apartment building because it produces rental income and appreciates over time. A speculator buys it because prices are going up with no concern for cash flow or risk. The same pattern repeats in every financial bubble. In the late 1990s, people bought any company with .com in its name. In 2021, the same happened with meme stocks and crypto tokens. Billions were poured into projects no one could explain. And when the hype faded, fortunes vanished. Graham taught that real investors focus on 3 things: thorough research, understanding how a business makes money, protection of capital, minimizing risk before chasing reward, reasonable expectations, aiming for consistent, achievable returns, not get-rich-fast miracles. Warren Buffett has echoed this for decades. He often says, if you wouldn't feel comfortable owning a stock for 10 years, don't even think about owning it for 10 minutes. His point: buying pieces of great businesses is investing. Buying tickers hoping they'll rise is speculation. It's fine to take risk, but do it intelligently, not impulsively. If you understand what you own and why you own it, temporary price drops don't scare you. If you don't, you're just guessing, and the market punishes guesses. If you're getting real value from these lessons, hit the like button. It helps more people discover smart investing principles like this. Rule number 3, always demand a margin of safety. Even the smartest analysis can be wrong. Companies stumble, economies slow, and surprises happen. That's why Graham introduced the concept of a margin of safety, a built-in buffer between an asset's value and the price you pay for it. Think of it like building a bridge designed to hold 30 tons, even though the heaviest truck that crosses it weighs only 10. That extra strength, that safety margin, keeps it from collapsing if things go unexpectedly wrong. Investing works the same way. If you calculate a stock's fair value at $100 per share, a cautious investor doesn't buy it at $100 or even $90. They wait for $70 or less. That discount cushions you against mistakes, downturns, or bad luck. luck. During the 2008 financial crisis, panic drove prices down across the board. Warren Buffett saw solid companies trading for half their true worth, so he bought. He invested in firms like American Express and Goldman Sachs when others were running for the exits, because he knew the businesses were fundamentally strong and he was getting them at a steep discount. It's not about being right all the time. It's about leaving room to be wrong. When you have a margin of safety, even imperfect decisions can work out. When you ignore it, even great decisions can backfire. Graham's advice was timeless. The essence of investment management is the management of risks, not the management of returns. In other words, protect the downside first. The upside will take care of itself. Rule number 4. Know what kind of investor you are, defensive or enterprising. Benjamin Graham taught that every investor must decide who they are before deciding what to buy. There are 2 types, the defensive investor and the enterprising investor. A defensive investor values simplicity, discipline, and minimal effort. They prefer predictable, long-term results over constant activity. Their toolkit is simple: broad, low-cost index funds like the S&P 500, automatic monthly contributions, and occasional portfolio rebalancing. They don't try to outsmart the market. They trust time and compounding to do the work. An enterprising investor, by contrast, treats investing as a profession. They analyze financial statements, study industry trends, and look for undervalued opportunities that others miss. This approach can deliver higher returns, but it demands serious time, patience, and skill. It's like fitness. The defensive investor takes daily walks, eats clean, and stays healthy for life. The enterprising investor trains like an athlete, measuring everything, tracking every result, aiming to compete. Both paths work, but only if you pick one and commit fully. Buffett began as an enterprising investor in the 1950s, studying obscure small companies, trading below their book value. But as his capital grew, he shifted toward a more defensive, long-term philosophy, buying wonderful businesses and holding them indefinitely. He realized success isn't about doing more. It's about doing what suits you. The mistake most people make, trying to be both. They buy like an enterprising investor during booms, then panic and act defensive during crashes. Graham's rule is simple: know which path fits your personality and stick to it through every cycle. Rule number 5. Master emotional discipline. Your mind is your greatest asset. The final rule, and the hardest one to master, is emotional control. Benjamin Graham said, "The investor's chief problem, and even his worst enemy, is likely to be himself." Markets rise and fall constantly. Sometimes prices drop 20% for no logical reason. If you panic, you'll sell great businesses at the worst possible time. If you get greedy, you'll buy overpriced ones just before they fall. Emotional discipline is the skill that separates long-term winners from everyone else. Warren Buffett embodies this. He doesn't chase hype, and he doesn't run from fear. In every major crash, from 1974 to 2020, he followed his plan while others abandoned theirs. He buys when prices are attractive, holds for decades, and ignores daily noise. To stay calm, you need a system. Invest automatically each month. Rebalance occasionally. Focus on value, not headlines. That removes emotion from your decisions and keeps you rational when others aren't. Think of the farmer analogy Graham used. A farmer doesn't dig up his crops daily to check if they're growing. He plants, waters, and waits. Investors should do the same. During the dot-com bubble, panic wiped out fortunes overnight, but those who stayed invested in profitable, real businesses recovered and grew far wealthier years later. That's the power of patience. The intelligent investor doesn't aim to outguess the crowd. They aim to outlast it. When others lose control, you keep your discipline. That's how real wealth is built, quietly, steadily, and intelligently. If these lessons helped you see investing differently, subscribe for more breakdowns of Warren Buffett's smartest strategies so you can invest with logic, not emotion.